Hello, I'm Robert, and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. This week has been an interesting week as we conclude a very interesting bearish run. And I say conclude in the context of the week itself, not necessarily the bearish run itself, as I'm not too sure yet which way things are going to go. But by looking at the order book, I don't believe price is going to go too much further downwards, as we can see some very clear, strong support levels that really do take into account a lot of aggressive activity. But we have the opportunity, with this being the weekend, to really look at the market in a non-moving state. And that's what I want to talk about today. Looking at the market through algorithmic trading, through the lens of what the machine can bring to the table. Because more often than not, when we use these tools, traders around the world are all using the same tools. They see the same things, many of which see and perceive the same concepts based upon how they were taught or educated. Algorithmic trading is the purpose of doing just the opposite. The point of algorithmic trading isn't to look at the market the same way as 10,000 other people. There's a saying that's very true in trading in general for all markets. 90% of all people lose 90% of their money the first 90 days of trading. Now, when you look at this statement, it seems obvious that there are a lot of uneducated individuals just gambling. And while that is true, it underscores something that is very critical that does need to be looked at. Many of these people are educated. They have taken professional trading courses. They have gone through professional, real, credible mentors that are teaching proper material. And yet they still lose money. The realization is trading is a zero-sum game. In order for you to make money, somebody has to lose money. You can't profit if somebody isn't losing the amount you're profiting. That is a realization that is a critical and fundamental part of the market. This is more than just a competition against you and the machine, or who can outsmart the institutions. While the institutions have a role, retail traders are their own worst enemies, as they all want a piece of that pie. They all want to be the 10% that can make a living just trading daily. That isn't going to happen realistically for 90% of the people who aspire to get into that 10% bracket. But that is the whole point of what algorithmic trading brings to the table. It isn't just about placing a buy order or a sell order at a given price point. As I've demonstrated over the last countless months, the actual process of placing a trade is only a few lines of code, whereas a program is hundreds to thousands of lines of code of analyzing market data, downloading the order book and tearing it apart, looking for opportunities, looking at the exit point for profits and pips. The bulk of algorithmic trading really isn't the trading part as much as the analysis part. And that is the problem that we see with all of these tools that everybody uses worldwide. And that is, these tools are collectively being used. And having these tools being collectively used means more than likely there are going to be collective losses. Because people like me that understand this, who think differently, or who look for opportunities that don't fall in the normal spectrum of trading, are going to look at this chart and see this is going to be where people are going to put a lot of stop losses. I want that money so I can make a profit. Therefore, I want to push the price down to here or lower. In other words, I want to be part of the harvesting process. I want to make money off of people that just blindly follow pretty little pictures. And that really is the whole point of what algorithmic trading is. It really should be called algorithmic analysis, because that is what I do every single day. I write programs that analyze the market, that help me see where to buy and sell to try to capitalize on staying profitable. Those programs also help me pick the right position sizes so I know how far I can push the market before I get bit and lose money. It also means I evaluate my risk by looking at where the market has gone, where it has been, and try to predict or forecast where I think it will go based upon all of the information that the program provides. This pretty little picture is wonderful and has an incredible value of opportunity in it if you know where to look and how to use it. So let's get into the VPS and actually take a look at this picture differently. Here is the same exact picture you saw just a few seconds ago. Everything with highlighted information to help me see what the market is doing. For example, here is my resistance level. Here is my support level. And this is the volume or the amount of trades weighted by the entire order book. So out of the entire order book, 0.51% of the market is right here at this price. And for my support level, 0.83% is right here at this price. These are critical points to pay attention to because these are where people are going to place their stop losses or take profits, either close to or around these areas. By examining the order book, I can see that it is slanted towards the buy side, but very minimally. The higher the buy volume is versus the low volume tells me which way the market is likely to go, based upon the actual orders being placed. This becomes a paradise and treasure trove of information for somebody that is looking to understand and project where they believe the market is likely to go. We can see from this information and from the bigger picture that we talked about over the week that Euro USD is still going to trend upwards, but based upon the order book, it's not going to be trending as aggressively as it has been. As I spoke about in my last forecast, the Euro USD is losing momentum, and that is an incredible and valuable piece of information if you're looking for the market to reverse, or if you're looking for the market to move from long positions to short positions. Now, of course, the one thing you are not told is how long that process will take. It could be in this semi-neutral state for a day, for a week, for a month. You don't know that. But by knowing that it is changing directions, you can prepare and think about that in a context that lets you really see the market in a different point of view. And that is what we are going to focus on specifically, looking at the market in a different point of view. Here is the very same order book, but we are looking at it differently. Now the numbers take into account something that the regular order book does not. This particular view looks at where price has been. It doesn't do any good to have a process that predicts where support and resistance has been if there's no price activity to verify it. You want to be able to look at where price has been and calculate the probability that price is going to return. And that is exactly what this particular approach uses. Instead of just standard order book analysis that relies on the weight of the short positions versus the long positions, the volumes of the trades. That is, how much is somebody investing in that trade price level. This takes an additional point of view, and that is, where has price been? How many times within a certain time frame has price been at a given level? And by weighting the order book with that particular price information, we get a different picture of where the market is likely to go based upon a probability of what it has already done. For example, on the buy side, support really is right here. This is supported because this is where price has been several times. This is where price is currently. This is where price is likely to revisit in the near future. And that brings us to where price has been, and then right here, zeros. Price has not been here at all for the process that this program has been watching. And it has taken into account 80 plus thousand bits of tick data. So in 80,000 tick data polls, price has not visited this areas. It doesn't matter that the level of volume that has been purchased at this level is quite substantial because price hasn't gone down there. If you're looking for opportunities of stop losses and take profits, you want to look where price is likely to go. Now, if you're looking to hedge against harvesters, then you want to use where price hasn't gone. And instead of using the highest point of view, you'll want to use a lower point of view for your stop loss. Because, well, price hasn't been here and there isn't much volume in this position. So statistically, it's not likely to be targeted. Whereas, this is likely to be targeted. So if you're looking for a short position, you could open here, close here. And you have a process where you can capitalize on those targets. And even for your opening position, you could look higher up for a region that doesn't have a lot of traffic, or lower, depending upon what your trading approach is. We can see the bid-ask price, and we can see the relationship of where the support and resistance is in relation to the bid or the ask. So we can see statistically that this point of reference is more likely to be targeted than, say, this point of reference or this price. So by using that is our mechanism for trading, we can develop an algorithm that will capitalize on this knowledge. So rather than just blindly following the weight of the order book, which may not have any value, as right here, large numbers of purchases are slated to go off right here, but price hasn't been there in a significant amount of time. This particular cycle has a month's worth of data. So within 1 month, price has not been at this level. That's important to know because now you have a time frame reference, because it can tell you how fast the market is moving, particularly if you track this over a series of multiple days. By tracking and watching the market with such detail, we can see the ebbs and flows of the market by actual price action movement and correlate that with actual order information on the broker. And this works on all exchanges, not just Forex, but cryptocurrencies, stocks, it doesn't matter. By utilizing frequency weights and frequency counting in relation to where price has been, correlated against the volume of the order, we get a better picture of market sentiment and market direction. We can see, just by comparing the weights, that the weights are actually more weighted sell side than they are buy side. That is another important distinction. Whereas the regular order book says that the volume is weighted for buy side, actual price weighting shows just the opposite, that the order book should be weighted sell side, and that actually correlates with the current projected market situation where the bears are holding control. So by looking at price action, this is telling us that the weighting of the market is going to continue in a bearish downtrend. Now, of course, we don't know how much, but we can see from the standpoint of the gap between the asking price and the target volume. The distance is quite substantial, but when you look at the bid versus the actual price, the distance is quite short. So we have correlations that not only give us the direction, but the fact that it is indeed losing momentum. In other words, the distance isn't that great, and the value has been retested. So we are likely to see support hold, at least in the short term. And we are likely to see resistance hold quite strongly over time, meaning the time being perhaps a week or so. So the likelihood of price going above this level is not as strong as the likelihood of price going below this level. So we have a correlation of where we can open up a short position or where we can open up a long position. Right now, where the bid price is so close to the support level, this would suggest the perfect opportunity for a short-term long position, because it has to cover all of this distance before it could reach this as a target point. And as far as a stop loss, well, because we know that price has drastically dropped, we can go down and look for the lowest level of volume and use that as a realistic stop loss to help protect our position. So we have an algorithm. Whether or not we actually use it in terms of a bot doesn't matter, because that's not the real purpose and point of algorithmic trading. Algorithmic trading is tools and information. Now, as I do, I use this to build bots that will process this information for me. But that isn't always the case. You can take the greatest traders in our country or any country, and most of them will take information like this, and then they will place trades by hand over the course of the week. Some traders will get up on Saturday or Sunday morning before the markets open, look at the market data that they can pull, and then literally place their trades for the entire week based upon buy and sell limit orders, which is perfectly fine, and this information provides a treasure trove of things to be done. For example, set up a buy order at this price with a take profit at this price and a stop loss at this price. And you have a full, complete order that will run by itself based upon real-world price data, real-world market movement. Whereas if we use just raw order book data, we don't get all of the information that I just described, not at the relevant levels of where price has actually been, or the fact that the actual price weights favor selling more than buying by quite significant. So, when you're looking at your algorithms, when you're looking at why you want to learn what a moving average is doing, or why you want to tear the market apart at a specific point where is the moving average swinging low or swinging high, you want to look because you don't want to be part of a 90% using common tools taking collective losses. You want to be part of that 10% that is searching for the methodology and means by which to stand out. And that really is the critical point of the whole process. You want your trading to make you money. So, in order to be part of the 10%, you have to use common tools in an uncommon way. Euro USD has been trending downward lately in a bearish trend, but its counterpart, USD Canadian, has been trending upwards in a bullish trend. And we can see by looking at the order book just exactly how support and resistance takes place at the volume level of that order book. But so much of this information is misleading and doesn't really tell you where price is likely to go or where it has been. But if we take this information, paying attention to market direction and order book weight, we can see and correlate this information differently. We can actually see how the weights of the market are likely to proceed. And this tells us a lot more because now, unlike Euro USD, this price here has not been hit in over a month. But because it is right by the resistance line, we are likely to see it get hit. We are likely to see prices continue to move higher. And because price has already visited here by quite a substantial amount, we can only confirm that USD Canadian will continue, at least in the short term, for prices to continue in an upward trend. So having the long positions is very important as a look ahead for the market. And we can see that the difference or displacement of frequency weights for a given price point is really very significant compared to the frequency rates for a given sell point, meaning longs versus shorts. This market is heavily cited for long trading, not short trading. The other thing that stands out here, which is very interesting, is you have the highest volume on the table with the highest frequency rate. And that is really very interesting. You have one down here that is higher, but it doesn't have the frequency of visitation. So this gives you a point of reference where you can expect price to respect within the market over the next few days to potentially a week. So understanding the market direction, understanding where price has been versus where price might go, calculating the statistical probability of these factors gives you an edge that 90% of the market doesn't have. It gives you a way of looking at the market with a different point of view and a different representation of just where the market is likely to go next. And I believe, looking at this, Euro USD is going to continue trending downward at least somewhat. But USD Canadian is going to continue trending upward at least somewhat. Here we can see that the volumes are quite significant above the resistance zone. So we can see, at least all the way up to about right here, that there's a good chance that we could see 1.3665 as a good representation of what could come this week. I personally use the 0.50 mark as a rough area of where prices are likely to not go below for market direction on the sell side. The buy side too is good, but it's kind of a neutral point from what I have personally observed in watching these markets. It's not guaranteed, so you need to think of it as a zone and not a precise situation. But by watching it over time, you will gain the sense of what the market is likely to do more often than not. Using this type of a situation, you gain information. So by studying both Euro USD and USD Canadian, looking at two different markets moving opposite of each other, we have confirmation in both markets that they are going to continue in their current directions. So as you explore the world of algorithmic trading more, don't focus on just the buy and sell or building a bot aspect of what the algorithm is. Focus on the potentiality of tools that help you analyze the data quicker, because you may not necessarily want a bot to trade for you, but rather have the advantages of the machine process large quantities of data very quickly, as this program does for me. It takes thousands of prices in an order book and it drills it down to a very simple table that tells me a wealth of information. So as we continue with the Learning Python series, These are just some of the tools we are going to build in a programming state. Understanding the programming aspect of the algorithm is critical to being able to envision your approach and point of view in the market. We aren't necessarily going to spend a lot of time tearing apart tried and true indicators unless there's real value to look at that indicator in a different point of view. That is, we're not out to copy what TradingView, TradeStation, or MetaTrader already does. You need a basic understanding of the indicator so that when you are looking at the market for here, this opens the door to a moving average on frequency rate, a moving average on volume, so forth, where we can actually see and begin correlating useful information and developing indicators that function on the order book, not necessarily on the candlesticks. We are taking trading to the next level. We are taking it to a point of view and a reference point that isn't commonly practiced. The success of that really is an unknown. It may work or it may not work, but the goal is to give you information that you're not looking at the market the same way as everyone else. If you found this video useful and helpful, please give it a thumbs up. It really does help the YouTube algorithm, and it helps this channel grow and spread. If you have any questions, please leave them in the comments. Thank you for watching, and until next time.